Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights and inspiring stories. Today, we're exploring decreasing interest rates, what it means for borrowers and investors. This is a crucial topic that affects us all, whether you're an entrepreneur, investor, or simply someone looking to make informed decisions about your finances. So, let's start with the basics. What are interest rates and why do they matter? In simple terms, interest rates are the cost of borrowing money. When you take out a loan or credit card, you're essentially paying for the privilege of using someone else's money. The interest rate determines how much you'll pay in addition to the principal amount borrowed. For borrowers, lower interest rates mean cheaper loans and more affordable payments. On the other hand, investors rely on interest rates to earn returns on their investments, such as bonds or savings accounts. The history of interest rates dates back centuries, with early civilizations using various forms of lending and borrowing. However, modern interest rates as we know them today began taking shape in the 17th century with the establishment of central banks. These institutions play a critical role in setting monetary policy, including adjusting interest rates to control inflation, stimulate economic growth, or mitigate recession. One key concept is the supply and demand for credit. When there's high demand for loans and limited supply, interest rates tend to rise. Conversely, when demand is low and supply is abundant, interest rates decrease. Another important factor is inflation expectations. If investors anticipate high inflation, they'll demand higher interest rates to compensate for the expected loss in purchasing power. Influential thinkers like John Maynard Keynes and Milton Friedman have shaped our understanding of monetary policy and interest rates. Keynes argued that government intervention through fiscal policy can stabilize the economy during times of recession, while Friedman advocated for a more limited role of government in economic affairs, emphasizing the importance of monetary policy. So, how do decreasing interest rates play out in real-world scenarios? Let's look at some examples. During the 2008 financial crisis, central banks around the world slashed interest rates to stimulate economic growth and prevent a global recession. This led to a surge in borrowing and spending, which helped stabilize the economy. More recently, the COVID-19 pandemic prompted many countries to cut interest rates to near zero or even negative levels, aiming to mitigate the economic impact of lockdowns and social distancing measures. Another notable example is the rise of fintech companies, which have disrupted traditional lending models by offering more affordable and accessible credit options. Platforms like Lending Club and Prosper have connected borrowers with investors, creating new opportunities for both parties. However, this shift has also raised concerns about risk assessment, regulation, and the potential for market bubble. If you're a borrower, decreasing interest rates can be a great opportunity to refinance existing debt or take out new loans at lower costs. Consider consolidating high-interest credit card debt into a single, lower-interest loan or exploring alternative lending options like peer-to-peer lending. For investors, the picture is more complex. While lower interest rates may reduce returns on fixed-income investments like bonds, they can also boost stock prices and stimulate economic growth. Diversification is key. Consider allocating your portfolio across different asset classes, including stocks, real estate, and alternative investments. As you navigate the world of decreasing interest rates, keep in mind that every great business starts with action. Don't be afraid to seek advice from financial experts or conduct your own research to make informed decisions. Remember, staying adaptable and continuously learning is essential in today's fast-paced business environment. In conclusion, decreasing interest rates are a powerful tool for stimulating economic growth, but they also have implications for borrowers and investors. By understanding how interest rates work and how to navigate changing monetary policy, you can make informed decisions about your finances and business strategy. Be sure to like, share, and subscribe, And remember, every great business starts with action. Make your next move count.